How do you measure tail risk? Have you ever wondered how traders prepare for those unexpected market crashes? Today, we are going to talk about tail risk and how to measure it effectively. Tail risk refers to the chance of extreme negative outcomes that can happen in the stock market. These events are rare but can lead to significant losses. So, how do we measure this risk? One common method is through option-implied tail risk measures. This approach looks at the prices of deep out-of-the-money put options. These options gain value when the market drops sharply, reflecting the market's expectations of extreme downside moves. A well-known measure in this area is the Bollerslev and Todorov option-implied left-tail risk measure. It uses the prices of these deep out-of-the-money puts to predict future tail events. Another way to measure tail risk is through stock return-based tail risk measures. This method relies on historical stock return data to estimate how severe the left tail of the return distribution can be. One technique used here is extreme value theory. This method helps model the tail behavior of returns that exceed a certain threshold. Expected shortfall is another useful metric. It measures the average loss when losses exceed a specific quantile, like the worst 5% of returns. Additionally, traders can estimate tail risk factors from intraday return data that go beyond certain negative thresholds. Now, let's talk about some practical tail risk metrics. Value at risk estimates the maximum expected loss over a certain time frame at a specific confidence level, like 5%. However, it does not provide details about the severity of losses beyond that threshold. Expected shortfall, also known as conditional value at risk, gives a clearer picture by measuring average losses in the worst-case scenarios beyond the value at risk cutoff. Tail risk metrics are essential in options trading. Traders use these measures to price and hedge options, especially deep out-of-the-money puts that act as insurance against market crashes. Tail risk hedging strategies often involve buying these puts or using dedicated tail risk funds or exchange-traded funds that hold a mix of long-dated out-of-the-money put options and safer assets like treasury bonds. Monitoring option-implied tail risk indices can help traders anticipate increased market stress or potential crashes. This allows them to adjust their portfolios accordingly. To protect against tail risk, traders can hold long volatility positions, such as long put options, which gain value when markets fall sharply. They can also allocate to low volatility equities or diversify across different asset classes to reduce exposure to extreme downside moves. Trend-following strategies that exit positions during downturns are also effective. In summary, measuring tail risk involves analyzing market prices of deep out-of-the-money puts, applying statistical models to historical returns, and calculating risk metrics like expected shortfall. These measures help traders and portfolio managers assess the likelihood and impact of rare but severe market downturns, guiding them in designing strategies to mitigate potential losses.